What's going on, everyone? My name is Oleg, and today we're going to go ahead and talk about 5 different stocks that I see the most value in. The point of this video is for me to show you guys exactly how I do evaluations on my stocks. I'll give you a couple more ideas for you to invest into, and hopefully you guys will be able to find a lot of value in this video. Make sure to watch this video in its entirety because every stock that we're going to be talking about is going to be representing its own market. I'm going to go over the financials of each one of the companies. We're going to talk about some of the recent news, and I'm going to give you my explanation of why I'm investing into this company. Without further ado, let's go ahead and get started. The first stock on our list is going to be AT&T with the ticker symbol T. When I searched for the major providers of cell services in US, I was able to find 4 major companies that exist in US. 4 of the largest wireless telecommunication services include Verizon Wireless with 119 million subscribers, T-Mobile has 98.3 million active accounts, AT&T Mobility has 92.2 million, and Dish Wireless has 9.2 million active accounts. And these numbers were pulled from the second quarter of 2020. Even though I see a lot of value in each one of those companies, I want to make sure that I pick the one that I see the most potential in. If we look at the historic chart, we're going to be able to see that the company is currently trending at a low levels of its price on the 10-year chart. Throughout years, investors are buying and holding the stock because it's offering a very generous 7.01% in dividends. Due to comparatively low fluctuations of the price of the stock between $24 to $30, it can find a lot of support at the price that it's currently trending at right now, especially when it comes to the time of economic uncertainty. Looking at the 6-month chart, we can see that after a big sell-off in the beginning of 2020, the stock bounced back and has found its support around $30 per share price. Let's go ahead and move our attention to the earnings report. We can see that the earnings are expected to drop in the next quarter. But if you look closer at the amount being paid out per share, we can see that the fluctuations of 18 cents are not as significant during the global recession. Now let's go ahead and move on to some of the news that I was able to find about this company. During the conference call, CEO Randall Stephenson estimated that AT&T's cash dividend payout ratio for 2020 would remain in low 60s, compared to just over 50% in 2019. He also added that AT&T remains committed to its dividends and that they have gone through a lot of different crises before this. AT&T already suspended the buybacks in March, which is supposed to free up a little bit more money for dividend payments and the gradual reduction of its long-term debt. Healthy reactions like this one are extremely appreciated amongst the investors. During the times of economic uncertainty, it's only smart to not buy back more shares of your company just to increase the valuation. Next company that we're going to go ahead and discuss is going to be Chegg. CHGG for a ticker symbol. Chegg is a direct-to-student platform that provides support for students when it comes to learning from remote locations and helping them adapt to new normal. With a tremendous amount of uncertainty, a lot of schools are converting to online classes. Chegg is the company that takes the leading role in providing students with the answers and solutions to their course materials. The stock of this company has already doubled since January of 2020, but it is here for a long time, not a good time. They have a 52-week low of $25.89 and a 52-week high of $89.82. with a market capitalization of $9.66 billion. If we look closer at the financials, we can see the moderate but positive return on assets of 1.62%, and their income statement shows quarterly revenue growth of 63%. There's a lot more room for improvement of this company. Their financials are great, and they beat last 4 quarterly earnings reports. With schools just now getting back into session, I'm expecting Chegg to actually beat the expectations of their earnings report and blow it out of the water. My justification for the expectation of this, that on the fact that the company is tapping into a market of 36 million high school and college students in US alone, not to mention largely unexplored international opportunities. We will make sure to follow up with this company within the next couple of months. Moving on to company number 3. Let's talk National Beverage Corporation with the ticker symbol FIZZ. FIZZ is a company that develops, produces, and sells a variety of different flavored beverage products. Company's portfolio consists of LaCroix Curate, LaCroix Nicola, and Shasta sparkling water products, plus a few others. I just want to take a second and appreciate you guys and say thank you for supporting this channel. Those of you guys who are subscribed to the channel, liking the videos, and staying active in the comment section below, motivating me to actually create more videos like this and bring you more value. So let's go ahead and move back on to the financials of the company. FIZZ has a 52-week low of $35.71 with a highest price of $70.64 per share. Their last quarterly earnings report was estimated to be 60 cents per share, while it ended up beating the expectation by 30%. Their profit margin is at 12.99% and return on assets is at 18.82%. Their current debt to equity ratio is at 10.86. Before the Q2 report came out, they ended up announcing that their main brand LaCroix Water achieved the channel growth of 27.4% in its category within 4 weeks prior to the end of June of 2020. Personally, I find a lot of value in this company because they're providing tangible goods for just about 50% of US population. If we take a look at 5-year chart of FIZZ, we can see that it found support around the $40 and was now successfully showing continuous growth ever since March of 2020. Personally, I think it's really interesting to watch some of these companies grow because a lot of people are not spending their money on taking cruises to Bahamas or flying to Caribbean. They are actually just spending money on the tangible goods that are bringing them a little bit of happiness, a little bit of value just on everyday basis. That is exactly why I think that this company is going to do really well regardless of the economic outlook. Our fourth company is going to be the most undervalued company in our list today. Now we're going to go ahead and dedicate some time talking about New York Mortgage Trust Fund, NYMT for a ticker symbol. NYMT is a real estate investment trust that focuses on purchasing, maintaining, and investing into the mortgage-related and financial assets. The price of the 52-week range shows that the price fluctuated between $0.98 and $6.47 per share. It is currently trending at $2.58 a share and offering a generous 7.49% on dividends. If you look at the quarterly earnings, we're going to be able to see exactly where and when the price of the stock ended up dropping more than 80%. Earnings for the Q1 for 2020 were busted and sank the share's price. Q2 was a little bit better than expected, and now we're expecting approximately 5 cents per share just on upcoming earnings report. Under recommendation trends, we can see that the company is currently trending at buy and hold. An analyst price is about $3.04 a share, which is about 15% higher than the current price. The shares of this real estate investment trust were hit the most because of low interest rates and inability to relocate renters from the properties that they're living at right now because of the forbearance. We're coming into this review and this discussion with understanding that the interest rates most likely are not going to go up within the next couple of years. But let's go ahead and take a look at the different side of this. When it's beneficial to borrow money, a lot of people are refinancing and borrowing more money, which makes it very difficult and very competitive for other people to get into the market. In this case, for our company, it's going to actually be more beneficial because it drives the prices of the real estate higher. The number of existing home sales across the country grew by 24.7% to 5.86 million last month compared to the 4.72 million homes sold in June, according to the National Association of Realtors. My personal experience supports this data because I ended up purchasing a house in DMV area just about a couple of weeks ago. It was extremely difficult and extremely competitive. The very first house that we ended up bidding on ended up receiving more than 20 different offers within 3 days. A lot of people were actually waiving the inspections for the house, and we were not able to get the deal. Luckily, we were able to find the property that we really liked, and we were able to take advantage of the low interest rates. Congratulations, you made it to the very last company. And the very last company is Hertz. Just kidding, it's not Hertz. Can you imagine if I would start pitching you Hertz or Luckin Coffee? Luckily, I'm not going to do that. I spent a lot of time trying to figure out which market I want to explore and which company I would like to point out as the very last company in this video. For the last pick, we could have talked about EA, Electronic Arts, or Nintendo Corporation, or even ESPO, since people are going to be streaming a lot more within the next couple of seasons. Even though I see a lot of potential in those companies, I would like us to focus our attention on the ones that are less likely to fluctuate during the economic uncertainties. Stock pick number 5 is going to be Dominion Energy, with the ticker symbol D. This company provides electricity and natural gas to homes, businesses, and wholesale customers. Under the recommended rating section, we can see that the company is between buy and hold rating, with the analyst price target being slightly higher than the current trending price. 52-week range for this company is between $57.79 and $90.89 per share. It is currently trending at $78.64 and is offering 4.84% in dividends. If you look at the full chart available on Yahoo Finance, we can see that the company is offering a continuous growth all the way from 1980s with a constantly increasing dividends. On 18 August, Dominion Energy actually announced that they acquired Madison Solar, which is 62.5 megawatt generating facility in Orange County, Virginia, and it will start commercial operations from the second quarter of 2022. The company is 57% done with their plan to increase their capacity by 3,000 megawatts by 2022. Green sources of energy are becoming a lot more popular and as a result cheaper. Dominion Energy is leading the way in this. Down in the description below, you are going to be able to find the article that talks about their plans all the way to 2050. One thing that we all need to understand about utility companies is that they can actually raise their prices during the economic uncertainty to justify their output. This makes utility companies are not recession-proof, but recession-savvy. I hope you guys were able to find a lot of value in this video, and as always, don't forget to smash that like button below, subscribe for more, leave me a comment, and I'll see you in the next one.